Hi and welcome. In this video, we will continue talking about the stock investing. Try this activity by yourself. Find the stock. Investing in a stock is buying a piece of the company. So, search the internet to match the brands with the company stock that owns it. What stock ticker, example AAPL for Apple, would you buy if you want to invest in the growth of the following products? For example, ESPN, Pampers, or YouTube. Let's talk about beating the market. To start, let me introduce you to Warren Buffett. Mr. Buffett has been the single most successful investor since the late 150s. Let's set the stage. The year is 1984. Presently, there had arisen a growing consensus that the stock market was fully efficient, called efficient market theory. Basically, academics and investors were declaring it possible for someone to consistently pick stocks that would beat the overall market average because everything was priced in already. Columbia Business Schools hosted an epic debate as a contest between Michael Jensen, a professor from the University of Rochester and one of the leading voices of the efficient market theory, versus Warren Buffett, a famous stock picker. Jensen went first. He argued that if you flipped a coin 50 times, there would be someone that happened to get heads 50 times in a row, but that didn't mean that the person had skills. He called picking stock a coin flip. Then Buffett spoke. He said, let's imagine that we had a coin flipping contest, and that of course we could have some lucky winners and losers. But then let's assume that all the winners had something in common. What if all the winners of the coin flipping contest came from Omaha, or had an unusual technique? Would you be curious to find out what made this high concentration of winners? Buffett then went through the investment performance of 9 successful investors that had just happened to all practice the same methodology and had all the same teachers, Benjamin Graham and David Codd. He called them the super investor of Graham and Dudfield. Buffett was unequivocally declared the winner after his masterful speech. No one could doubt the numbers or the logic. The clear conclusion is that you can be successful in picking stock, and it requires following the investment principle of Graham and Dodd and Buffett, of course. Buffett references Benjamin Graham and David L. Dodd together. Graham and Dodd wrote Security Analysis in 1934. This book, still in print after several editions, had influenced many great investors since the very first publication. Additionally, Benjamin Graham wrote The Intelligent Investor in 1949. Mr. Buffett first read his book in 1915 and considered it by far the best book of investing ever written. Benjamin Graham is considered the father of value investing, and so we start here. As you read the article, make a note of the key concepts that are referenced. Some are repeated several times. Some questions to consider. Number 1. What are the common traits of successful investors? Number 2. If there is a clear recipe for investment success, why do you think so few people follow it? Now, let's see the 7 golden rules. Being successful at anything requires following a set of rules. Good rules are the accumulation of decades of wisdom summed up into a few components that really matter. Successful football players win because they avoid penalties and because of the way they train. Successful students get A's because of the way they study. Investing in the stock market is no different, except that when you succeed in investing, you make money, a lot of money. Take Warren Buffett, for example. He started out with $10,000 and turned it into a net worth of $60 billion. But he's not alone. Peter Lynch, Bill Ruane, Wallace Kloss, Bill Miller, Charlie Munger, Joel Greenblatt, and many others generate simulate extraordinary investment returns consistently over a long-term time horizon. Each successful fund manager's style was simply different, but if you study them each carefully, you'll start to see significant patterns. We summed this pattern into 7 golden rules. So, without further ado, here are the 7 golden rules of successful investing so you can crush it in the stock market. The rule number 1. Think long term. Trying to time the stock market or risking it all to double your money in a year is at best speculating, at worst gambling. You may as well just take your money to Vegas and lose it there. Those who are able to successfully navigate the stock market are not speculators or gamblers. They are investors. Investors know they can beat the market because they think differently, they think smarter, and they think longer term. Time horizon arbitrage means that if investors learn to think long term and can see beyond the daily and quarterly noise, they can gain a real upper hand. In 1964, American Express was a great company, but the stock was getting hammered due to the insurance scandal. The company had to pay millions of dollars in fines due to the accidentally underwriting barrels of vegetable oil that turned out into pig water. That is exactly the time when Warren Buffett began purchasing the stock. The best investors look beyond short-term distress and keep their eyes on the long-term horizon. Warren Buffett said, "Only buy something that you'll be perfectly happy to hold in the market shut for at least 10 years. The rule number 2. Good companies make good investment. People need to understand that investing is not like placing a bet or wherever the Cowboys win over the spread against the Packers in the big game. Investing is not trying to get the quarterly press release a microsecond before the other person. It is not even about trying to predict which stock that you will think go up the most. Fundamental investing is buying a tangible piece of a business or a share of that business. And your investment portfolio, or the collection of all different shares you own, is only as good as the sum of all the companies in that portfolio. If you buy shares or high-quality companies in resonance price, you'll end up with a high-quality portfolio with less risk. It's as simple as that. Good companies are ones that have a unique advantage that others can't copy. Good companies are ones that generate high returns on capital. Good companies don't need to borrow a lot because their business is self-dancing. Warren Buffett said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Rule number 3. Buy with a margin of safety. Nearly every professional investor began his career reading Benjamin Graham, The Intelligent Investors. Warren Buffett called it by far the best book of investing ever written. What makes it so special? One of the reasons is because it introduced the important concept of margin of safety. In investing, a margin of safety is formed when one buys and invests at less than its value while using conservative assumptions. The idea of a margin of safety is that you want to buy a business at a price that is low enough that your assessments could be completely wrong and you won't lose much. Rule number 4. Do your own homework and own what you know. There is no substitute for your own work. Buying a stock because CNBC recommended, or because your uncle recommended, or the stock shark look cool is a sure way to lose money. Successful investors know what they own. They buy stock of companies with products they believe in. Successful investors go the extra mile to analyze the financials of the company to make sure they're not missing anything. Remember, most of the extraordinary gains made in the stock market come after a stock is punished or after it has already risen a lot. But you're not trying to have the conviction to stick with it unless you really know the company. Rule number 5. Don't follow the herd. Stay calm and rational. The typical buyer's decision is usually heavily influenced by those around him. Buy when others are buying, sell when others are selling. Unfortunately, this is a recipe that its bones backfires. The best investors are ones that can fight this urge and remain calm through the storm and remain on the sidelines through a bubble. The world's greatest investor, Warren Buffett, said it best. Be fearful when others are greedy, and be greedy when others are fearful. Rule number 6. Don't put all your eggs in one basket, but don't have too many baskets either. Diversification is one of the most critical strategies for your portfolio so that if one stock blows up, it won't sink the entire ship. As much as we think we won't make a mistake, we will. Even the masters do, and that is why we can put all your eggs in one basket. There's power in diversification. However, research suggests that 90% of diversification benefits can be obtained in most markets with a portfolio of over 20 stocks. The more you diversify beyond that, the less you know about each investment. See the rule number 4. Your first and second best ideas are always better than your 100th best idea. So while diversifying is crucial, make your best ideas count. Thanks for watching. We hope you learn with our content. We will continue in next videos.